Good morning, everybody. Happy Friday. Today is SKC office hours. My name is Sarah Krom, managing partner of SKC & Co CPAs, and we have one big office hour to go through today. A couple of housekeeping issues that I will run through a little bit on the quicker side because we do have a lot of content today. Our session is being recorded. It will appear on the resource section of our webpage, and you will also get an email early next week with the link to that. So if you want to reference it in the future, or if you want to share it with a colleague who couldn't join us today, please feel free to do that as well. If you are a past joiner on office hours, you know we typically don't have slides. We usually do a relaxed fireside chat conversation. There's a little bit more content to this one, so we put together just a few slides for you, which we will circulate as well in the email that goes out early next week. As always, we want this to be as valuable to you, the attendee, as possible. So please, if you have any questions or comments throughout the chat, throw that in there. I will manage it as best as I can going through this presentation. That being said, this is a topic that could be skewed political. We're staying far away from that. We're talking strictly tax law and strategy. So if you could keep it to policy and not politics, that would be very much appreciated. We do have the ability to kick you out, and I just don't want to do that. So we could all be on best behavior this morning. All right, last bit of housekeeping before I introduce you to my wonderful guests. We're going to be using some acronyms today, so I'll just kind of lay those out for you. The TCJA is the Tax Cuts and Job Act, which was signed in 2017 and effective in 2018. We're also going to be saying BBB or OBBB, which is one big, beautiful bill, which is the legislation that was just passed. And if we reference any sections with numbers behind them, those are the IRS code sections. So trying to make this as user-friendly as possible. My guests today are none other than my partner, Andrea Diaz, and SKC's Director of Tax, Nicole DeRosa. Welcome, ladies.
Thank you. Happy to be here.
So we've got a lot to unpack today. There's a lot in this bill, to say the least. It could go on probably for 8 hours, but we did try to stay as focused as we could on an audience that was going to be the business owner, and we're trying to give you a mix of strategy along with some of the policy changes to make it as beneficial for you as possible. So let's jump right in, if we will. Nicole, we're going to go through some of the wins that we see as business owners with this bill. And we're going to start with two of my favorites, which are the SALT cap and the pass-through entity tax, which are somewhat related. So Nicole, if you could walk us through these, please do so.
Yeah, absolutely. And I can echo you with the fact that I was excited about these being passed simply because they affect me. So that they made the final cut, I was really happy about that. But we all became quite familiar with the big fat $10,000 cap on state and local tax deductions. However, the cap has been increased to $40,000 for joint filers and $25,000 for all other filers beginning in tax year 2025. That deduction will be indexed for inflation year over year beginning in 2030. The cap will then go back to $10,000, assuming no further legislation is kind of passed to extend this temporary increase. So definitely a win on that front. Something that's also important to note is that the SALT deduction is subject to a phase out for high earners. So those who have income that exceeds $500,000. So just kind of keep that in the back of your mind as well. Despite this phase out, the deduction would still not go below zero. So kind of a good and a bad. If you make too much money, no changes. If you don't make as much money as the high earners, then you're going to have a higher cap. On the other side of the coin, let's now talk about the pass-through entity taxes. Huge win here. There is no SALT limitation for pass-through entities. This is something that I know I was personally kind of worried about, just because it would make our lives as practitioners a little bit more difficult. And on the business side front, it would also make a lot of businesses' lives more difficult because there was a lot of back and forth on this. But in the end, the big, beautiful bill came out looking like a shiny penny. And for those 36 states and one locality who have implemented a pass-through entity tax SALT deduction, that is allowed as a deduction in calculating your federal taxable income.
So a couple things on this, and sort of this one was really, as I said, a personal favorite of mine. The AICPA, which is our national organization for CPAs, lobbied really hard to change what was in the House bill version of this related to pass-through entity tax. I know we at SKC reached out to our senators personally in May. I was on the Hill directly lobbying for this to get changed. So this is a huge win compared to what could have been based on some of the earlier versions of the legislation. So we're very, very happy about that. The other thing that overall is obviously relevant to the SALT cap, but to several other things throughout this presentation, pay attention to two things: the income limitations on a lot of these things, which are really important. And number two, the effective dates on things. A lot of things are retroactively effective. Some things are effective up into a certain point into the future. So it's kind of important to really focus on those things. And then my last overall statement on this is if you're looking at articles or reading things and you just stop at the headline, you're going to be really ill-informed, and you really should read the whole article, because a lot of the 10 words or less that are in the headline are not really capturing the full story on a lot of these components. So it's really important to dive in a deeper level. Okay, all that being said, Andrea, let's talk about some surprises, I think, that came out of this bill, both with respect to depreciation. So why don't you start with a little bit of Section 179 and then move into the bonus depreciation side of things?
Sure. So just for overall, so we all are talking about the same things. These are really three buckets when it comes to capitalizing and depreciation. So you have your regular depreciation, then you have Section 179, then you have bonus depreciation. So those are three separate ways, three different ways, I should say, to capitalize and depreciate your capital assets. So when we're talking about 179 expensing, that's an immediate write-off in year one when you're purchasing any of your capital assets. The OBBB increased the limit from $2.5 million a year to $4 million a year, which is a huge increase, meaning you can, a lot of companies can buy now equipment and other items, anything that has a useful life less than 20 years. I shouldn't say anything. Generally, if it has a useful life less than 20 years, it can be 179 and expensed all in year one. Bonus depreciation, they made permanent 100% bonus depreciation, which just means you can also take 100% of the depreciation in year one. So a lot of people ask us, what's the difference between Section 179 and bonus depreciation if you get 100% deduction in year one? And there are some material differences. And so you have to be very careful when choosing which section, code section, that you want to apply. For example, 179 does not allow your business to, you cannot expense to allow your business to go into a loss position. The loss would be hung up. However, if you use bonus depreciation, that bonus depreciation can create a loss that is allowable on your pass through on your return. So you just have to be mindful of which code sections you're using. The other item that to be very mindful of is certain states, and we do have a slide later on of state conformities, but certain states decouple from federal when it comes to 179 and bonus depreciation. So it's very specific to your current situation, whether you want to take 179 or bonus. But the win here is that there are multiple ways now to be able to expense 100% of your capital investments in year one when purchased. Backing this is also an increase to the business interest limitation. So there are certain interest limitations, interest expense limitations. They've increased those limitations, which makes financing for these pieces of equipment and other items much more lucrative, because now you may not be limited for the interest. So that goes hand in hand with both of these. One of the biggest items of depreciation that I was shocked about, I read it multiple times and couldn't believe it, for new buildings, for manufacturers, they have, the OBB has implemented 100% deduction in year one. So typically it would be
She's so excited about this. I
So
have to tell
excited.
you, I'm going to have her say it again because she's so excited about this.
Well, I was just so surprised. I've never seen it. Typically, you have to depreciate a building over 39 years. And now you get 100% of that building to depreciate it in year one. There are very specific rules around it: when construction starts, when construction ends, when the building goes into service. There's very specific language on what qualifies and what doesn't qualify and what has to be included in that building once the construction is done. But it's a huge win for manufacturing companies and for our clients. So anybody who's on this call who's a B2B provider, if your clients are manufacturers, that's huge for them. That means a big increase in their disposable income, hopefully, to be able to spend. So just a lot of wins on the Section 179 and bonus depreciation aspect.
And so if you're thinking about that sounds crazy, why would that be part of this law? I think, and I don't know this, but I'm thinking that the intent behind it is to bring things back to US soil and create the manufacturing environment back here in the US. This is one incredibly accelerated way to do that. So we'll see what happens as a side effect of this, if you will. But Andrea, is there a specific date around the depreciation and when assets were purchased? Because I was having a conversation with somebody and this random date of January 19th, 2025 came up. And I said to them, well, that's, inauguration day. I said, they can't pass tax legislation in this first term that goes prior to when he was inaugurated. So there is a date of January 19th. I don't know if you want to touch on that in any way, but if
Yes.
anybody bought anything in the first 18 days, might not be a good outcome.
Right. You'd still have the ability to 179. You just wouldn't have the increased limit from 2.5 million to 4 million. Bonus depreciation prior to January 19th of this year for 2025 was 40%. So that is a big jump from 40% to 100%. And we actually do still have the ability, the OBB allows taxpayers to elect to utilize that 40% bonus depreciation through all of 2025 if that's what the taxpayer intended on doing for strategic planning purposes. So there is still that opportunity, but anything prior to January 19th for the first 18 days of the year are still under the TCJA rules and historical rules that we've been utilizing for the past few years.
And Nicole, another big win, I think, on this bill for business owners is this research and development or R&D expenses. And this was a situation that we had been watching a couple years back, hoping that Washington would do something to change the legislation as it sort of expired, and that never happened. It got rolled up in a couple bills that just didn't make it, quite honestly. But we got our wish granted with the OBB. So tell us a little bit about the R&D here and the expenses related to the credit.
Yeah. Oh, research and development. This was definitely a biggie. And I feel like we waited some more and nothing happened. And we knew that, this was going to be a very welcomed and much anticipated change. Quite frankly, it was just a matter of when. So yeah, for the last few years, we reluctantly amortized domestic expenses over 5 years, and then those foreign expenses over 15 years. Now we're able to immediately expense those domestic expenses just like we used to. So we're kind of going back to what we were familiar with a couple of years ago. Unfortunately, though, for the R&D for the foreign expenses still remains at 15 years. Again, I think another incentive to bring things back to the US and, have it domestic here. So it's still extremely welcome by many. And I would say this is a pretty huge win. And in addition, this is kind of one of those little carve outs. The bill provides small businesses with the option to apply this change retroactively back to 2022 by amending their tax returns, as well as accelerating any remaining R&D deductions that are basically kind of hung up on the balance sheet as unamortized. So obviously, pick and choose whichever one is more. I mean, I'm a huge fan for accelerating it in the current year rather than going back and opening up prior years, because that just gets messy. But translation, you can basically have a really, really big ordinary expense for 2025 because you're accelerating your unamortized R&D deductions that are hung up on the balance sheet. So that's a huge tax planning opportunity that hopefully you're looking at right now, just because you're like, oh my gosh, I have all these unamortized expenses, and now you can just take them in 2025.
And another, go ahead, Anj.
Well, I was going to say, I'll add to that. Not that anybody on this call did this, and not that anyone was ever advised to do this, but when R&D expenses started to be capitalized in 2023, Nicole, so I guess it was for tax year 23, 24, so 25 would have been year 3. Some people thought, well, I'm just not going to take the R&D tax credit. I'm not going to capitalize my expenses. And now that you can expense and get the credit, I would not open a prior year tax return if you've expensed all your R&D expenses and didn't take the credit just to get the credit now that you know you can expense it, because you're basically waving a red flag that you didn't do something right. So
Right.
be very mindful about how you would go about amending. The good news is going forward that you have the ability to expense 100% of your R&D expenses and get the credit.
Right. And just to clarify that, if you did not take the credit in 22 or 24 when this law changed, you were still supposed to capitalize your expenses, is Andrea's point. So don't now go back and say, well, great, let's redo all these years with the R&D credit. Bad idea.
Yeah.
But again,
Not
this,
fancy amending.
yeah, we're not fans of amending. The R&D piece here is, again, something to pay attention to when it comes to the states as well, because this will be, for most people, a very lucrative benefit for 2025 to expense all of that catch up. But again, you're not going to have the same situation on the state side. So continuing with some wins, I'm happy to say that we have more win slides than we have loss slides. Andrea, if you could walk us through some of the changes made on the opportunity zones as well as Section 1202 stock.
Sure. So if you recall, during the TCGA, they introduced opportunity zones. The opportunity zones have been around forever. However, in the TCGA, it gave taxpayers the opportunity to defer capital gains when they invest in opportunity zones. This was a 10-year asset that was supposed to somewhat retire after that, right? There wasn't an opportunity to continue to invest in these opportunity zones once that 10-year phase closed. They have since OBB reinstated opportunity zones every 10 years. So what that means is each state must qualify certain specific parts of their state as opportunity zones, areas that need infusion of capital to improve the status. There are income thresholds and other thresholds for being able to qualify as an opportunity zone. And now every 10 years, the states can reassess and reapply so that these opportunity zone investments are still available to defer capital gains into them. So it's expanded the opportunity zones in general. Before OBB was passed, all of the capital gains that were deferred from infusion between 2018 and today would have had to been picked up on your tax return at the end of 2026. So that there's still certain rules around it, but it has extended any new investments. So if you had made a new investment this year, you may have had to defer capital gain in 25. You may have had to pick it up in 26. You no longer do. A new investment in an opportunity zone for this year would push forward your deferral for 5 years. So that is a huge win, and just the opportunity to be able to continuously utilize this as a tax planning strategy is great. Now, there are other strategies also within the opportunity zones, meaning it's not just a deferral of 5 years. You get a step up in basis. So if you were to defer $1 million, or let's use $100,000 of capital gain into an opportunity zone, if you hold it for a certain amount of years, you can get a step up in your basis, meaning when you do have to eventually pick up that gain on your tax return, you may only have to pick up 90,000 of capital gains instead of 100,000 of capital gains, because you get a 10% step up. The other win is that any gain made from any increase in value in that investment. So if that $100,000 turns into $150,000, that additional $50,000 is not taxable. So big win for opportunity zones and for our taxpayers who are, consistently seeing capital gains. And this is only for capital gains, so this is not ordinary income. So just keep that in mind. Section 1202 stock. This is a big one. There have been a lot of changes over many, many years, but I was really happy to see this. So Section 1202 stock is qualified small business stock, meaning you qualify as a small business if you are a C Corp and you have less than, historically, prior to OBBB, if you had less than $50 million in assets at the time of becoming a corporation. And you held the stock for a certain period of time. So you were the original owner of the C Corp stock. You held it for 5 years. You were historically allowed to, when you sold that stock, exclude up to $10 million of gain. So if you had qualified small business stock and you had a $10 million gain on sale, you did not have to include it in income, but you had to hold the stock for 5 years. The changes are, if you now hold the stock for 3 years, you get a 50% exclusion. If you hold it for 4 years, you get a 75% exclusion. And the 5 years, you still get 100% exclusion. So it opens up the door to years 3 and 4 being able to sell your qualified small business stock and still get an exclusion of income. It also increased that $10 million cap to $15 million. So that's a big win. That's a 50% increase there. And it also allows businesses to qualify up to 75 million in assets. So the number of C Corps that will qualify increased. The exclusion allowed under the bill increased, and the timing of how long you have to hold it has reduced to get at least some of the benefit. So there are multiple aspects of that win, and we've seen a lot of business owners come to us and say, should I be a C Corp? I would love to take advantage of 1202, but then they don't want to hold on for 5 more years, because typically they come to us when they're only 2 to 3 years out and say, I want to sell in 2 to 3 years, let's start planning for this. At least it gives us that opportunity now that you can become a C Corp, and most business owners will say, I can hang on for 3 years for a 50% exclusion of the gain, and then if you hold on longer, it just works that way. Then you get 75% or 100%. But having that initial target of 3 years is great, and the increase in the exclusion.
So I will say they did do a lot of wonderful things with this bill, but they also made things a lot more complicated. So everything that you're hearing now is sort of just scratching of the surface, and does warrant a deeper conversation to your specific situation, whatever that might be in each of these areas. But definitely, go ahead.
No, I was going to say the strategies for these two things. Opportunity zones just means if you have gains, short-term or long-term capital gains, you have more opportunities to defer them and invest in different items that will also allow you to continuously have tax free income. And Section 1202 is if you're looking to sell your company within the next 3 to 5 years, then it's definitely something to think about converting over to a C Corp. There are a lot of complexities. This is very high level. This is not, everybody should become a C Corp tomorrow, because there are only certain industries that are allowed, but definitely some wins for those that qualify.
Great. Nicole, I'm so excited about this increase, the 1099 reporting. Can you tell us a little bit about the change there, and then roll into the new employer provided childcare credit?
Sure thing. So, I mean, honestly, no surprise here on the 1099 front, just because I feel like this can was constantly being kicked down the road on an annual basis with the increased threshold. So in my thought, I mean, it was a matter of time. Again, just when we kind of didn't have that crystal ball, we didn't know exactly when it was going to happen. But both the House and the Senate actually agreed to the informational reporting threshold, that it would be $2,000 per calendar year, which is up from $600, which is pretty significant. So the threshold amount will also be indexed for inflation annually, beginning in calendar years after 2026. So hopefully this will lighten some taxpayers' 1099 filings. Fast forward to 2026, it's actually January 31st falls on a Saturday. So the due date for 1099s will be February 2nd. We have a couple of extra days to hopefully get those decreased amounts of 1099s in, because hopefully there will be a lesser volume in that. As for the employer provided childcare credit, the House and Senate actually agreed on this one too. So we're seeing, believe it or not, it was a little bit smoother of a ride for some of these provisions than others with the back and the forth. These two just happened to both agree, House and Senate. Historically, there was a credit up to 25% of qualified expenses with a maximum credit of $150,000. Now we have a credit up to 40% of qualified expenses, so a significant increase there, with a maximum credit of ready up to $500,000. So this one was huge. But wait, if you are a small business, that percentage increases up to 50%, so even more, and the maximum credit increases up to $600,000. So just like a bunch of the other items we've talked about, this is also indexed for inflation, and be kind of cognizant of the little carve-outs within.
Great, thank you. Andrea, there are, to round out the wins here, a couple of extensions that were made permanent from the Tax Cuts and Jobs Act. So can you run us through those to round out the wins for this one?
Sure. And I'm going to go back to depreciation one quick second, just because there was a pre-submitted question on depreciation. And it was, were there any changes to depreciation of racehorses with OBBB? And there were not. And real estate renovations not resulting in ordinary income recapture, there were no changes there. So just wanted to answer that. Also, if your pre-submitted questions aren't answered throughout the course, then we will send out an email answering all of those. So some of the items that were extended or made permanent from TCJA to now are individual to income tax rates. They went down with TCJA. They're continuing to stay. They were supposed to expire at the end of this year, and they're not expiring. The standard deduction, the increase in standard deduction has been made permanent. So the TCJA had it expiring again at the end of 2025, and it was made permanent, and also will increase for inflation every year. Personal exemptions that were set to expire at the end of this year are made permanent. So the OBBB change is that personal exemptions were suspended from TCJA. The OBBB suspension is permanent, and now there is a $6,000 deduction allowed for seniors, phased out for high income earners. So we're not getting the personal exemptions back. If you remember, you'd had a deduction for people and then a standard deduction or a personal exemption. There's no more. We haven't had personal exemptions in a few years, and we're not getting that back. The child tax credit was expanded, and the OBBB made it permanent, and that was increased to $2,200 per child. For businesses, the qualified business income deduction, which is really big, the 20% deduction against your business income, was made permanent. That was set to expire at the end of 2025, which is a huge win for business owners. And they've increased the threshold on service businesses on who qualifies. So that's exciting. They've increased and made permanent the estate and gift tax exemption. It went up to 15 million and will be continued to be indexed for inflation. So that's a huge win. The AMT, if we remember AMT, many people haven't been in AMT in many years because of TCJA. They had increased the exemption and phase out thresholds, and those increased exemption and phase out thresholds have been made permanent. So hopefully, most taxpayers will stay out of AMT, where we were all dealing very much with AMT prior to 2018.
Alternative minimum tax. That was one of the acronyms I forgot to announce in the beginning, but that's AMT, as alternative minimum tax. Basically, what it said was, if your return isn't calculating enough tax, we're going to make you have to pay alternative minimum tax, which is more than what your return calculates.
Right. Right. It was like a flat 28% or something. It added back some things, it reduced some others, but ultimately, after 2018, most of it was mostly for high income earners, and most of our high income earners were out of AMT, so they were eligible to pay the lower tax. Nicole already went over the SALT deduction, itemized deductions. There were some other small items in there that were not extended or were extended that we'll send out a full list, but likely not going to impact your business for this year.
I will say one thing really quickly. If you are being adventurous and trying to Google some of this stuff, just be careful, because I know for QBI, the qualified business income, between the House and the Senate version, there were a differing percentage. One was 20%, one was 23%. And I know if you type it into Google, it still sometimes comes up, hey, QBI is now 23%. That is not the case. So just be cautious when you're looking into some of this stuff, that you are looking at the final bill that was passed, not the prior versions that were kind of going back and forth, because there are differing versions out there, and the 23% is not the final QBI amount.
Yes, and
point, Nicole, 'cause I've
that goes with our disclaimer of don't just read the headline.
Yes, exactly, exactly. And I've seen some people ask about it because they thought
Yeah,
it was increased to 23% because that's what's out there. Also, try not to use AI when looking up these items, because Chat GPT and all they don't have the final bill uploaded. If you look at their last um, time
update.
that they were uploaded their information, it was probably earlier this year. So it's not as of July 4th.
Right. All right, so that rounded out the wins that we had to share with you. Sadly, there are some losses as we feel with respect to business owners. So Nicole, if you could start by walking us through those related to the mortgage limitation and then the deductibility of interest on home equity loans.
Well, I mean, there is a plus side. I'm a glass half full kind of gal. There is no change from what we were working with since the Tax Cuts and Jobs Act was first introduced. So if you didn't, have a limitation, or if you had a limitation, you're not going to, it's business as usual, basically. The $750,000 acquisition indebtedness limit was set to expire after 2025, but now this has been made permanent, and I am going to air quote that, because in the tax world, when we use the word permanent, it really basically just means temporary until new legislation possibly changes it. So for now, it is permanent at $750,000 of acquisition indebtedness. And similarly speaking, the disallowance of the home equity debt interest expense has been made permanent as well. House and Senate actually agreed on both these items. So I can't say I'm really honestly that surprised, but I mean, no harm, no foul per se, because nothing is technically changing.
Andrea, there are some changes that happened with respect to charitable deductions, and then there's I think a pretty significant one related to gambling losses. Can you share that with the audience?
Yes. So charitable deductions, there's one win and one loss. So glass half full. The win is that for taxpayers who don't itemize, there is now a permanent above the line deduction, $1,000 for donations for individuals, and I believe it's up to $2,000 for married filing joint. So that's great. However, for those who do itemize, there is now a base uh, before your charitable deductions become deductible. So it's a 0.5% base. So it 0.5% of your adjusted gross income. So if you made $1 million this year, your deductions that are over 0.5% of $1 million would be deductible. So it's similar to now medical expenses. Medical expenses are 10%, but there is a floor where you're not going to get a deduction. The strategy around that is to potentially start using some donor advised funds and bundle your deductions in year one, or 1 year, and then use those deductions use that donor advised fund for a few years. If you know that you're going to have a lower income year or a higher income year, you just want to be cognizant of your gifting and philanthropy during those years, and make sure that you're talking to us or whoever your advisors are, so that you can plan accordingly to maximize your deductions. Gambling losses. So historically, if you had gambling wins of $100,000 and you had gambling losses of $100,000 and you were an itemized taxpayer, then your $100,000 of losses automatically offset your $100,000 of income, and it washed it. No harm, no foul, no taxes. The change here is that gambling losses are now limited to 90% of your wins. So if you had $100,000 of gambling wins, you're only allowed to take up to $90,000 of your gambling losses to offset. So this is going to be a big change in how Casinos report, typically we get at the year end or during tax time, if we have some folks who are gambling, we get the statements from each of the various casinos, and it gives us a net number. Here's your net wins, here's your, net number. You had a loss or you had wins, and we apply accordingly. This is going to change how casinos report. So in all of these things, keep in mind there are changes underneath in systems on how things are being reported, which is going to take time to implement. So more on that later, I'm sure. But these are two of the losses that will hurt some individuals.
And
And
also,
just to clarify on that point, I know Andrea specifically spoke about casinos, but it's also online gambling, right? So if you're doing DraftKings or, a similar app to that, this gambling it's a whole umbrella of all of that gambling.
and two follow-ups, just GoFundMe's on the charity side, just be wary of GoFundMe's because depending on what the underlying cause
Beneficiary.
it may or may not be tax deductible as a qualified 501c3 charitable deduction. And then also on the gambling side, New Jersey, we're a gross income state here. So it'll be really interesting to see how the states kind of apply that. And will New Jersey agree and only let you net it down to, a 90%, or will it fully let you net it down to 0? Question mark.
And so the next bullet we have here is about higher income taxpayers. And correct me if I'm wrong, guys, but this was kind of a general statement because there's a lot of credits and benefits and good things that came out of this from a tax perspective and a tax savings perspective, but there are phase outs from an income perspective. And so if you're skewed to the higher income, which is defined in the various different credits and language in the bill, you in some cases either get phased out or are completely just ineligible for the credit depending on your income threshold. So again, this goes back to if you're reading the headlines, it may still not apply to you depending on where your income lies. The higher you are, the less you benefit is sort of the general takeaway from this. I don't know if either of you want to add to that.
I think that's a fair statement. They did increase the high income taxpayer threshold. Historically, it capped out around 400,000. A lot of what we're seeing is capping out around 500,000 or higher. So that is a little win inside this loss, but a lot of the benefits that we are seeing do cap out at high income. Another thing that we actually didn't have on here, but a lot of people ask about, are those miscellaneous itemized deductions that prior to TCJA, we were able to take things like moving expenses or at home office if you are a W-2 employee or your employees were asking about it. Those things, all of that, or what you're paying for financial advisor services, all of those deductions are now permanently disallowed.
And then the last piece on the loss slide here, it says energy credits galore. And, we came out of policy that was very rich with respect to energy tax credits. We have two whole slides actually on energy tax credits here. Essentially, general statement, they're kind of all going away. But Nicole, why don't you walk us through some of these energy credits that we're kind of losing here?
I mean, basically all. I know. Well, I mean, again, notice the effective date. So, I mean, if you want to buy a car that's energy efficient, you got to buy it sooner than later. But again, there was a lot of limitations on the income. So pretty much, I would say the one that we're most familiar with at this point is the previously owned clean vehicle credit, which a lot of people, in my opinion, didn't really qualify for anyways, because there's so many hoops that you need to jump through in order to actually get the credit. But this credit is going away. Qualified commercial clean vehicle credit, that was more of a business side credit, that is also going away. The alternative fuel refueling, tongue twister, alternative fuel vehicle refueling credit is going away. Energy efficient home improvement credit, this was pretty, I was bummed about these just because I need a new water heater in my house. So I'm definitely going to go buy that before the end of the year. Residential clean energy credit as well. And then I know there's a whole nother slide of fun too.
Yep.
Yep, lots of 179D. I'm gonna toss that one over to Andrea in a hot second, because that was a big one that is definitely going to impact, I feel like, a lot of taxpayers, and some other credits that I don't really feel like many people probably took much advantage of. I think that in the original green kind of energy credits, they were slated to apply to a lot more taxpayers than they actually applied to. So the numbers didn't exactly end up working the way that they had originally planned. So they're kind of just, I think, giving them the axe at this point to get rid of them and make things a little bit less complicated.
Yeah, and just because, I don't know, the government feels like accountants need job security, you'll notice that there's different effective dates next to every single credit here. So again, it's really worth a conversation with your practitioner because you need to be doing some strategic things and making choices. I think the latest expiration is the third one here, which is January 1st, 2028, but most of them are sometime in 2025 with a few in 2026. But Andrea, as Nicole said, can you talk a little bit about 179D? Because I do know that was a significant one for a few of our clients.
Sure, sure. And just so you, for all of these credits, with the exception of 179D almost, keep in mind we're not saying go out and buy new windows for your whole house right now to make them energy efficient. You want to see if while you're planning get the actual credit number first to see if it's worth the investment. It's only going to matter to you when you purchase or when you upgrade or when you buy an electric vehicle if part of your decision making is that you're going to receive a credit. So if part of your decision making is not that you want to receive a credit, if your decision is all about whether, however you feel about energy and solar and the economy, or how it relates to anything else, this is only for, if you want to make sure that you're getting credits. So 179D, the energy efficient commercial building, we've had quite a few clients take advantage of this over the past few years. And under previous law, it allowed you to take a pretty big deduction for improvements to your building. So there was solar that you could put on the roof and you'd get a 30% deduction. It also allowed you to reduce the amount of time. So if you put a roof on your building right now, I believe it's 39 years, it reduced some of the expense of the roof and the cost for putting solar on the roof to 5 years depreciation. So you got accelerated depreciation and a tax credit on top of it, which was huge. It's really impacted a lot of our clients that were making changes to the buildings that they owned or doing a lot of renovations to their existing buildings. This is getting terminated. The termination is based on the date the construction begins, not the date the property is placed in service. So it's critical distinction for planning purposes. In the property where construction begins on or before June 30th, 2026, the deduction remains available. So if you are planning on potentially improving your building, your commercial building, and you're going to utilize a lot of the energy efficient items in 179D, or I shouldn't say that. If you're looking to improve your building for any energy and you were thinking maybe it's a future item, you should definitely talk to us about it so we can see if it qualifies and what that credit would look like versus the cost, because that does go away next year.
That's
Great.
big.
Thank you, guys. All right, so moving from wins and losses into the unknowns. Ironically, there's a lot more unknowns than are on this slide, but again, our presentation's an hour, so we'll start with these unknowns. Andrea, there's something in the bill related to Trump accounts. Can you tell us what the heck that might be?
So I can try with the limited information we currently have. And as you guys have been with us through the TCGA, you know that once the new TCGA came out, it took probably 2 to 3 years to get regulations and guidance and clarity on all of the changes and the definitions on how to implement. Well, it's very similar to everything that was to a lot of things that we were just passed with the OBBB. And one of those is Trump's accounts. Trump accounts are accounts that you can open when a child is born between certain years from, I think it's 2025 to, I don't recall the end yet because it's could change. We need clarity. And you put $1,000 into this account and it's meant to grow and be tax deferred. So it's for young children, it's for new kids. That's what we know. And we know it starts with $1,000 investment. Outside of that, I don't know. We'll get more information on those if they become glorified, 529s or something along those lines. We don't know what you can use it for, who qualifies for it yet. I believe it's subject to income thresholds. Anyway, we'll have more to you when we know. You'll know.
So just a little background quickly about how things work, right? So obviously the legislation has passed and been signed, and it's now law. Now what happens is the IRS basically gets it, and they have to upgrade all their systems, upgrade all the forms, make all of the changes, which takes time in any environment. But you may recall earlier what happened with many of the IRS staff, that they were either furloughed or given accelerated buyouts for retirement. And so there's a much smaller pool of people who can now do this. So to Andrea's point with TCJA, when things took 2-ish years to really get the policy and the clarification around what was supposed to happen with some of these changes, we now have less staff working on that at the IRS level. So the next couple of things that we're going to run through, and Andrea, I'll kick it back to you. These are big buzzwords that are coming through the headlines, but we don't really know how they're going to appear necessarily in practice yet. And especially no tax on overtime and no tax on tips. I mean, that doesn't only affect individual reporting on your personal return, but it affects your payroll company. It's pretty overarching. So Andrea, what do we know about this and how it might work?
So we know that there's no tax on overtime, again, subject to income thresholds, and there is also a cap of the amount of overtime that is not subject to tax. And I believe that number is 25,000 for an individual, and I think 50,000 for a married couple filing joint. I may be mixing that up with no tax on tips, and I apologize if I am. But right now, we don't know how either a W-2 is going to report overtime hours. Like, how would an individual know? How is the IRS going to know what is overtime versus not overtime? We don't know.
How's the employee going to know to report it on their tax return?
Right. How will the employee know? How is the business, what responsibilities are on the business owner to ensure that the employee knows what amount in their wages are considered overtime versus not overtime. We assume, but we all know what happens when we assume that there's just going to be a new, reporting. Employers will have to report into payroll overtime, which they do anyway now, because overtime is a different compensation dollar. And now the payroll companies will have to provide that information. My assumption is going to be somewhere on the box 12 or box 14 on the W-2, which are catch-alls, we'll call it. There's always a new code that's added there. Same with tips, right? There's no tax on tips, again, subject to an income threshold, again, subject to with a max. And also, both of these items are subject to what they're calling industries that regularly have overtime or industries that regularly have tips. There has not been any guidance on the definition of those items, nor do we have precedents in court cases to know what the what the IRS could assume that definition is. So we're going to wait to hear what that means. We do know tips, at least restaurants, and but now you tip a lot of places, and so we don't know where that's going to land as it relates to industries or reporting practices and responsibilities on the business owners to ensure that employees are getting the information that they need to file correctly.
And I think
I mean, go ahead, Nicole.
Are very kind of confused because they're like, well, I don't have to, they don't realize it's a tax return deduction or an exclusion, and it's only federal tax that they're getting the deduction for or the exclusion for. And I know that the tax on the tips threshold for the income from married filing joint is actually low. It's 300,000, which is a lot lower than the 400,000, the 500,000 that we've tossed out earlier. So this is definitely a very, very gray area. And there's obviously going to have to be a lot of clarifying regulations and information that's going to have to come down the hopper first, because there's a lot out there that we still don't know about this.
I mean, the good news is we had tax legislation passed in July. I mean, historically, we have it passed between Christmas and New Year. So at least we've got a little bit of run up to get some information and for some of these changes to be made. I mean, I do still think there's going to be a pretty significant impact on the filing season. Nicole, why don't you walk us through what we're expecting when it comes to the 2025 filing season starting in Q1 of 26?
I mean, is this a trick question? There's obviously a lot of elephants in the room, and there's a lot of question marks, like I said, on specifics, which I anticipate light will eventually be shed over the upcoming months, whether it be the IRS issuing some frequently asked questions, or, they've been pretty good over the last couple of years with at least writing things in plain English so that we can decipher them and translate them. But the bottom line is the IRS has to still incorporate all of these changes, like Sarah mentioned, into the tax forms, which takes time. So they need to know which end is up first before they actually incorporate the changes, roll out the forms. And then once the forms do go final, every single tax software has to then incorporate the changes into the software. They have to map things accordingly, make sure, all the I's are dotted, all the T's are crossed, which this also does take time. And that doesn't even include the states. We haven't even addressed states yet. But the bottom line is that, things are going to get a tad messy and are going to be a little bit, in my opinion, last minute, because that's what happens when we have new tax legislation. I feel like we're going back to when TCJA was first rolled out and it was just mass confusion and a lot of delays. We're kind of going back there again to some extent. So to avoid potential errors, because the software is not going to be perfect, and ensure that everything is being appropriately taxed, appropriately treated, I do unfortunately foresee a year that many will have to file for extension.
Yeah,
Absolutely.
that's our public service announcement is
Yes.
Sorry, don't kill a messenger.
now it's July, so start to get prepared to go on extension already for April of 2020, probably March if you're a business, and then April if you're a human, in 2026, because that's just likely going to be the case, unless you have an incredibly simple return that none of this applies to, which is almost unheard of.
Right, exactly. And it's that this isn't going to change our tax planning. It's not going to change the way that we're looking at things from a year-end perspective. We're going to incorporate as much as we can and make assumptions as we always do. But we are asking for a little bit of patience, maybe through the tax filing deadline. A
little bit of grace.
little bit of grace. Yeah, exactly.
We did touch on this a little bit earlier, the state conformity issue, and we have a splendid looking map chart here. So Nicole, I don't know if you want to walk us through a little bit about the state conformity piece here, because I know this slide is your baby.
Yeah, I always reference this slide just because I'm a visual learner, so, and I also love colors. So this basically just shows you which states automatically conform to the Internal Revenue Code, IRC. It's called a rolling conformity. Those are all shaded in blue. We have states that conform as of a specific date. So, whether it be, 1/19 or July 4th or whatever it may be, that those are all shaded in kind of a golden color. And then 3 states, of course, we are one of them that has rolling conformity. So it kind of almost depends, if you will. A couple of states that don't have general conformity at all, and then 4 that just don't have income tax. So it doesn't really matter. It's not applicable. But again, every state is different in how they either agree or don't agree, or maybe agree in somewhat to the federal. So what we're talking about today is all at the federal level, and the states may or may not agree. They may or may not conform. They may conform as of a specific date, but this just basically says every state's different. So we also have to wait and see on, how the states are going to implement these federal changes.
Great, thank you. Any final thoughts for the audience, ladies? I know this was a lot. We kind of whirlwind through it. For sure, I know that there will be updates that we will bring to you if they come out in in a big bundle and are significant all at once, we'll do another office hour based on what we learn. But more likely they're going to kind of dribble out over the next couple of months. So we'll be doing probably short videos that we'll post on social media, or you would want to sign up for our bi-weekly newsletter so you can get those updates there, our 5 Things newsletter. But Nicole, Andrea, any final thoughts, words of wisdom, tips and tricks for our audience on what we could, how we could benefit for the next couple of months?
Yeah, the really, not to sound cliche, but the really beautiful part of this bill is the simple fact that it is still July, like Sarah had mentioned, and we actually do have time to plan. Historically, we've had tax legislation rolled out at the end of the year, and it's like everyone's kind of mad rush to figure out how to lower their tax bill in like 2 weeks. We have, fortunately, a lot more than 2 weeks now. So make sure you're looking at your cash flow, potential for lowering income through maybe planning to purchase necessary assets, and consider making especially your, Q4 pass through and tax payments, maybe make them in December, all depending on obviously cash flow, rather than January. And I always like to say, if you fail to plan, then you plan to fail. So be proactive and start planning now.
And the same thing goes with manufacturing. The hung up R&D amortization is huge. If amortized your R&D expenses, being able to expense them in all this year. That doesn't mean that necessarily you should, but you potentially can. And then the relocation, because of the exciting immediate deduction of our 39-year asset. The noteworthy items that are at the bottom, but other aspects, is keep in mind this was extremely focused on business deductions, business taxes, business owners, and all of the things that we should be looking at to plan for the rest of this year as businesses. There are many parts of this bill that we did not touch on, as you know. So if you do have specific questions about individual things in the bill that you've heard, and you reach out to us individually, and we can, or through the link, and we can certainly help you address any of those items.
Exactly. Terrific. I'll pull up our last slide here, which gives all of our contact information, because as Andrea said, you may have questions that are specific to your situation, or you may have, lots of things we hear about Social Security taxability and things of that nature. So if you have questions for relatives or anything like that, you want to reach out to us, please do so. Nicole, Andrea, thank you so much for joining us today and sharing your knowledge on this incredibly cumbersome bill that we are sorting our way through. To our audience, thank you for joining us. We hope that it was valuable. Again, you'll get a link to the presentation and the slides early next week via email. It will live on our resources page on our website. We do want these to be beneficial to you. So if you have thoughts or ideas for future office hour topics that you would like to see, please email us and let us know. And my closing thought for today is to stay cool and have a fabulous Friday and a very enjoyable rest of your weekend. Thank you all for joining us, and stay tuned to SKC for future updates and more clarity as it becomes available. Have a great weekend, everyone.